Hi, everyone. Today we are going to be discussing how actions turn idle money into assets. And for this episode, I have Serhii with me. He is a mathematician and one of the smartest people I know. So it's really good that he decided to join the show today. My background, for anyone who's joining us for the first time, is in applied economics. And Serhii, I'll let you introduce yourself, please.
Thank you, Alejandro. So my name is Serhii Nikolaiev. I have a background in finance, in mathematics, in programming, and also have PhD in AI. So,
as I said, one of the smartest people I know. Okay, so the conversation we're going to be having today is regarding what do you do when you have money in the bank and you're hoarding it in the bank, but you're not doing anything with it, right? It's a really safe. So my own personal experience comes from about 4 years ago. I had about $200,000 in the bank and it was just sitting there. And what I came to realize after some time is that the things that I was buying previously were not the same things that I was buying later. And it was because the amount of money I had to spend on them was not really compensating for the price changes, right? So if I wanted to get a hotel or if I want to get an airline ticket, regardless of like seasonal changes, I would see that from one year to another, the price simply went up and I could see the money in the bank was just corroding. And so I touched back on my knowledge from economics. And at this time, I was very early in the program and I was trying to understand, like, is there a better way to save money? And this is when I started to learn about the S&P 500. What I understood inherently is that if you simply leave cash in the bank, it's going to devaluate, right, over time if you do absolutely nothing with it. Because even the bank, like,
the biggest risk actually, because on the one side you think, okay, I have cash, I'll put it on the bank, it's super safe, I cannot lose it, and later I will buy something. But at the same time, it's not probably taking any action on those, and not taking action, it's like the biggest risk, because like Warren Buffett's story when he told that you can literally double your money, put into them to work, so they work instead of you, so you don't spend your time actually into work, but your money start working for that, and you have the snowball effect that literally accumulate wealth for you. But if you put them on the bank, you might say, okay, I don't want to risk to make my money work, and it's safe. But it's very interesting word you have just safe. What might be the risks actually there? Because you mentioned the erosion by the inflation, correct? And this is actually the anti-snowball that also has compounding effects that erodes the value. So you have the same notional number of banknotes on your bank accounts that you can get, but their purchase value differs this time greatly. So
yeah, and the thing that you think you have when you do that is liquidity, but in reality, the liquidity is shrinking because you're able to buy less things. And something else that people don't really think about is that when the money's in the bank, like the bank is giving you maybe $30 or $40 for a $100,000 investment every month, but the truth is that the bank is going on, it's investing your money and is making
absolutely
quite a bit of profit on it. So why can't you simply do that yourself, right? And you can through a brokerage account. And that's what we're going to be discussing today is how do you put your money in a way that will work for you all the time, right? This is something that I got, actually back in high school, my teacher said this. He said, think about your money as an employee. It doesn't need to sleep. It doesn't need energy. It doesn't need to do anything. If you simply leave your employee on the table, you're leaving an employee who is not going to work. If you work that employee, if you think about your money as an employee, this is an employee that can work 24 hours a day, 7 days a week. You simply have to put them to work in a smart way.
Absolutely. And this is very, very great analogy. And also you said liquidity. Very nice word. Can you explain for our audience, what do you mean by that?
Okay, so liquidity really is like your acquisition power, right? Like how much can you buy with the money that you have? Let's say you have $1,000 and you want to go on a trip that is going to cost you $1,200. Well, you're short by $1,200, right? How do you account for this extra $1,200? Your liquidity at that moment is $1,000, but you still need the $200 extra. Now, let's say that somebody gives you a 20% return over 3 months. Well, now your money is tied up to that particular investment and you're not going to see your money back until 3 months later. So now your liquidity is zero. But if you invest your money on liquid assets, that means that you can pull them out at any time and then the liquidity changes. The more liquid an asset can be, the lower the risk that is going to be tied up into something that's going to make you lose money. So liquidity on your investment is extremely important, especially if it's money that you are saving for something that you have to buy like 90 days from now, and you want your assets to grow for 90 days on an interest-bearing account or an interest-bearing asset. So liquidity is the way that you measure how much buying power do you have at any given moment.
And how fast you can pull it out and reinvest basically into something else. So from this point of view, like having cash, it's like the most liquid asset, but at the same time, like you have other assets which are also liquid. So can we deep dive into that, because it goes to an interesting way? I mean, the different asset types.
Yeah. So let's say that you have you have an opportunity to buy a house. So you go out and you buy your house. If you live in this house, your money's all tied up in the house. It is no longer liquid. The only way to get money out is if you borrow money, but then you have to pay interest on it, or if you rent the house, but then your liquidity becomes the rent when your tenant pays you, right? So your money is set up into a house, which seems like a safe asset if you want to hold it long term. But the only way you're going to see a return on this asset is if you actually hold it long term. Why? Because as soon as you buy the asset, you have to go and you have to pay all of these taxes and everything else that goes with it. So if you buy a house for 1 million, after you pay the 10% that you have to pay for buying the house, your worth is only like 900,000. Now you have the house to live in, you have to pay rent or anything else, but you're not going to see any liquidity from it until you either sell the house or rent it or borrow money against it. So your money is completely tied up.
Absolutely. And it's not liquid asset, because if you want to sell it, it will take you quite a lot of time.
It will take you some time to sell the asset.
Basically, this is two separate like parts of the spectrum, where you have super liquid asset and you have like less liquid asset. But let's talk about all the other things. So if you have like 200,000 K, you don't like need them instantly, right? So basically you can like distribute them in a smart way. So you have like some in liquid assets, some like non-liquid assets. So can you elaborate on this?
The reason for that is because you are risking the degradation of the money that you have available, either through fluctuations in cash or through buying assets that are sold on a different currency than what you're holding, or through simple depreciation because of inflation. So holding your money in cash is actually not the best that you can do with the money that you have. It's going to lose value anyways. With that, we can move on to the next section of our podcast. Let's see. Part 2 is how is a portfolio built and what it is made of. So to move into this, the first thing that I would actually like to do is you talked about something very interesting, which is different types of assets and different classes. And you brought with you something that's super cool, is the periodic table of assets. So I'm going to share my screen and I'm going to show this because I think it's something that people are going to be very interested in.
Absolutely. Because first time I saw about it, it's like, there is like periodic table of elements in the nature, but at the same time, smart people also were thinking, okay, we have like cash, what can we do with it? And they tried to actually classify all opportunities out there where like you can invest, but investing is basically like a two-sided coin. On one side, you have risk. On the other side, you have profitability. And literally, like if you get more profit, you get like absorbs more risk on that. And that's why I was asking about you. So like if you have super illiquid assets that can be like super profitable, but at the same time you have like super liquid assets that give zero like profit, like basically like currency, to hold some currency, because for each country, like if you take Japanese yen, it's also currency, you can hold it. It's also asset, but at the same time, there are much wider universe of different things that can give you profits. So Alexander, if you can like elaborate and go through and tell like which classes here, and because for me it was always very hard to think, okay, like if I want to buy gold, it's super secure, I need to go like to get physical one, and that was actually before the era where I knew that I can actually go and buy a stock for the gold, and it also like separate vertical, so we can talk about this. So can you elaborate on this part?
Yeah, so I'm looking at the periodic table of assets. This is a really super interesting table. Okay, so So the very first thing that I want to talk about is like common shares because it's right in the middle of the table itself. When you own a company, um, and you want to get money from investors, the investors are going to come and they're going to say, we are going to give you money because your company has a particular value. It's called a book value, and it is, let's say, $10 million. And you are issuing 1 million shares. So that means that every share is going to be worth $10. Unless you go through a preferred share, which means you're going to get paid first, you're going to get common shares, and that's what usually gets traded in the stock market. So once a company goes out and it has the initial public offering, what happens is that the common shares is what is being sold in the stock market to the majority of people. Now, when you're looking at the shares, you can also do like preferred shares, which is usually class A, or you can do common shares, which is like it can be class B or class C, but usually class A is what is listed as preferred. But we're going to focus on common shares. So what's a common share? A common share is a piece of the company on paper. That basically means that a certain amount has been allocated and very smart people have come together and they have said, based on all the assets that you have, if you were to sell this company today, the book value of this company is $10 million, for example, because you are selling 1 million shares. And this is like, just a very, very basic example because there's a lot more that goes into it. But just for sake of conversation, we're going to say that it is $10 a share. Now you go out into the market and then people start trading this, right? People start going off and saying like, okay, well, it sold for $10. I'm going to pay $11 because I think it has room for growth. So now this is like the present value of future earnings. People are saying, because the company is going to be worth more in the future, I'm willing to pay that now and hold it, right? So let me give like a really, really good example. When Facebook came out, within a month, it dipped down to $27 a share and it never touched that number again. Afterwards, it skyrocketed. The highest price that Facebook saw was just recent. It was like $760 a share right around October. And then it dipped down all the way to 590. So if you were, courageous enough to buy Facebook, which I'm not, I usually don't invest in Facebook because it's very volatile. But I did invest in it when they first opened a long time ago. I think they've been in it, like they had their IPO back in like 2016, if I'm not mistaken. Back then, once it dipped down to like 30, I bought myself a few shares with it. I think I spent like $1,000 on Facebook. And then afterwards, I cashed out when it got to like 300 and I moved my assets because then afterwards, I didn't really see a lot of room for growth, but I saw a lot of volatility on the price. Like I would look at the price one day and it was down $20, $30. I would look at it again, it was up $30. That is more than what my heart can take. Like I don't have the risk uh personality like some people are. Yeah, it's okay. I'm gonna go on a roller coaster ride and just put my money there later. Right now, I'm a little more safe when it comes to that.
Mhm.
Okay, so if we look
One more question, sorry to interrupt you. So like let's return back to our like example with the buying house. So basically before that we were saying that like to buy a house in real estate is actually like a very long-term non-liquid asset. But at the same time, do I get it right? This example with common shares, basically there are companies whose main valuation and value, for example, in real estate, that they build and rent and sell the property. And as a user, you can literally buy the share, which actually represents the value of real estate without the need of like buying the actual house, right? So this gives you like reduces these risks and gives you like the more liquid assets that you can trade much, much faster.
yeah, for sure. And so looks like I moved away from this. Yeah, and I have a table to show about that because what you're describing now is a sector within the stock market. So within the stock market, you have sectors, and those sectors, one of them is the real estate sector. So if you want to go out and you want to buy a house to make money from it, well, just think about it like this: you have 1 million dirhams or $1 million. You go, you buy a house. Over time, you're gonna make money on real estate. Unless you go back to like 2007 when we had the real estate crash because of secured back mortgages, but we don't really have a scenario like this now, right? Like now, real estate is pretty strong. So if you buy a house now and you hold it for a year or two, you're pretty guaranteed to make money on the sale of the property. But that doesn't mean you're not going to be spending money on the property itself, right? Because what if you get a leak? You have to fix the leak, right? What if your tenant doesn't pay you money? What if you live in the house and your taxes go? However, if you simply want to get into the real estate market sector, then now all of a sudden you can look at real estate, which would be here right in the middle, private equity. And so if you look at asset number 91 here, then this is referencing a real estate fund, right? So you can take money and you can either put it on an ETF, an exchange traded fund that is dedicated to real estate as a sector, or you can buy directly on the companies that are trading publicly, like Century 21, for example. You would need to look at their fundamentals. You will need to look at their average returns, and then afterwards decide whether or not you want to buy this company directly, or if you want to diversify your risk and buy within the real estate sector. So that's one of them that you can do here. And the good thing about that is that you stay liquid the whole time, because this exchange traded funds are usually very liquid when it comes to it, right? So if you open an account like Interactive Brokers or Charles Schwab or any other brokerage company that you're going to be trading with, you can buy the ETF, hold it for a while, and then sell it. And then you can see historically what is the return on it, and then how much money you're going to make. You can even buy.
Sorry, his name?
Right, you can even buy
Actually, sorry to interrupt. Like, go ahead.
Go ahead.
So, for example, here in Dubai, there are a lot of like building companies like Tamak, Imar, and others. So people mostly know this. But you also mentioned like ETF. Can you elaborate and explain to our users what ETF means?
So an exchange traded fund is a group of companies brought together and managed by a like a brokerage firm, right? Or a fund manager. So let's say, for example, you have like street funds. These are very famous ETFs. So these are SPDRs, right? Like they take a sector of the S&P 500, they bring it together, they bring companies together, and then utilizing those, they track the whole sector of the market. I believe in real estate is XLR, if I'm not mistaken. I don't quote me on that because I don't remember. I would have to look it up. But if you were
Look it
to
up
look,
and check it.
yeah, like, if it's something different, please excuse me. But yeah, but it basically takes, or XLRS maybe. I really don't remember off the top of my head. But when you look at this, when you look at how this has performed over time, you can see how much money this ETF has given you. But then if you look inside the ETF itself and you extract the companies, over time, you can see which one of the companies within that ETF have performed better and given the better returns on it, like how much is it weighted. Now, the good thing about an ETF is that if you have a good fund manager, these people will be doing the work for you. So you don't have to go and investigate and do all this extra labor. You just have to see like how much is the administrative cost of this ETF, and then you choose the ones that have the lower administrative costs or the ones that are giving the better returns, right? Something has this administrative cost, it will usually give you better returns than something that, costs a lot of money to manage. So that's what our ETF will do. And I am
Basically, as far as I understand, you can open to show the demo. And as far as I understand, like basically instead of buying shares of one real estate company, which can fail or which can have something, so ETFs basically group or like multiple companies, which also diversifies risk between them. So you are investing in real estate sector, and at the same time you're investing in the average performance. So you have no risks that if you invest in some companies that build houses and they just go bankrupt, you lose everything, correct? Correct. This is like one of the also huge benefits of ETFs.
So this is what I was talking about. This is the State Street Investment Management, and this is XLRE. So here, this is real estate ETF. And that's why I said don't quote me, because I don't remember if it was XLR or XLRE. So it's XLRE. So here you can see the performance, and this is showing you like over time how well it's been doing. Like what is the benchmark of it? Like what was it expecting to do? And then over time you're able to see how well it's been performing. So here this is what's actually important: the holdings. So this says that it holds the tab holders are like Welltower Inc., Prolonging Inc., Equinix Inc. So these are all the the companies that are being held, and then it says this is the number of shares that that this particular fund manager is holding for you, right? So this is State Street, like I mentioned earlier, and here we're able to see the holdings that State Street has said these are the ones that we're going to be managing. So if you buy XLRE, like you can literally go in the stock market and buy XLRE. So we're gonna actually see how that works. So we're gonna do here XLRE here. So XLRE, right? If you see this shows you what you would be looking into if you bought it. So if you held this for 1 year, let's say that you were thinking last year that you were going to be buying a house. You're like, okay, I'm going to buy a house, or I'm going to invest in the stock market. So if you go and you bought a house last year, and instead of like buying the ETF, you would basically have made $1, right? So that's really not that great of an investment. So a lot of times you want to look at what's in the ETF before you blindly go into it. And this is why it's really important to look at all these things, right?
Mm-hmm.
So now here, if we actually go through and we look at this State Street, sorry, they say that like the majority of holding is Welltower Inc. So let's see what Welltower Inc. is made of. So here we're going to do Welltower Inc. here. And this says that over 1 year, you see that? From 150 all the way to 207. So this is what I was saying earlier, that if you're going to buy your ETF, don't just go and blindly buy the ETF that you're going to get. Go in, investigate what the ETF has in it, and then buy the assets that are performing better within that very ETF. So now, what does that mean? That means that like a lot of the work has already been done for you. We know that State Street, they're smart enough to put these ETFs together. We know that they have a lot of holdings for this. And we also know that their ETF is heavily weighted on Welltower. So now we can come in and we can see the performance of Welltower. Instead of going through and having to investigate every company, we can take like the top 10 and we can see which of those fit within our requirement. So now let's say that
basically they have like voted with their money what they believe in and correct they put a stake on.
Correct. And then instead of you going in and having to do all this homework all over again, all you have to do is see which of these are performing well and build your own portfolio based on the information that you're able to gather from this, which is publicly available for everybody, right? So that's what an ETF can do for you. So now, when we're looking at this periodic table of assets, it's actually quite interesting. If you look at the right, you have collectibles. This would be things that are super illiquid. Because if you think about fine art, well, you have to hold it. And if you want to get your money out, you have to sell it to someone else. You have to exchange it or barter for something. Like, let's say you exchange a piece of art for a house, or you would have to have an auction. Same thing with rare coins, stamps, timepieces, and so on and so forth. Gold, not so illiquid, but still you have to go and sell the gold, or you have to trade it. So you have to go to a gold broker and do that, or you can buy the representation of it through a stock market. So this is also something you can do with an ETF, right? If you want to see like GLU, I think that's an ETF for gold, or IAU, it's another one. If you look at these ones and then you buy the actual stock and hold it for some time, as gold goes up, you can make a profit from it. And if it depreciates, then obviously you lose money. Same thing with crude oil, natural gas. All of this are either commodities or ETFs that you can trade with in the stock market. They just have a different identifier.
Absolutely.
Yeah. Okay. So now what we're going to do is we're going to be looking at sector allocations and how to decide what's a good investment and what's not, a really good investment. But before we move on, do you have any opinions or comments on this? You asked me a lot of questions. I try not to, ramble on about it. I try to be like as clear as I could, but I'm pretty sure that I may have lost some people out there. So did I lose you, or do you have any questions about these things?
Perfectly fine. It's really good examples. Like in one side, it's in theory, like what we have looked through in one sector of real estate. It gives like with this ETF capability to buy balanced, like risk-free, probably like ETFs that are created from multiple companies, multiple assets. But on the example of what we saw, is that you have to do your homework and actually check, because we thought it's like great graphs that we should show, but at the same time,
No, yeah,
the example of do your homework before.
oh yeah, you have to do your homework, and that's why real estate is such an interesting one because you think it's safe to just like throw your money in an ETF, and it's really not. Like you really have to do your homework with this. So what we're gonna be doing now is we talked earlier about what a good portfolio looks like and what it doesn't look like, and also like if you have an ETF that you have to do your homework, right? So what we want to do now is we want to go in and we want to show a software that I wrote, which automatically creates a portfolio for you. So what this does is it gives us like a portfolio showing us what should be purchased, based on the information that we have. Okay. So now earlier we were talking about real estate. So what this software that I created does is it goes through, it allocates information about everything from about 5,000 companies. It narrows down the scope by reading data from the Securities Exchange Commission. And then it tells you what are the expected returns from those companies, right? So this is the last price, and this is the predicted return from it. So now, obviously, if it's a negative return, you don't want to use it. If it's a positive return, you want to look a little bit closer into it to see if it's actually something you want to buy. And it breaks it down by sectors. So if we look at real estate in this one, for example, which we talked about earlier. So this one is saying that CPRE, it's a good fund to buy. So what we're going to be looking at here is trying to see if CPRE is actually performing well. So let's go ahead and look at CPRE. This is characterized rate. Here we go. So today it's not doing so well, but over 1 year, how well has it been performing? Okay, so you see that. So what does this tell us? This tells us that over a year, if you would have bought it at 24, right now you would have 40. So that is a 55% return in 1 year. But it's not just about price movement. It's about a stable price movement. So what I'm going to show now is going to be the plots that show us what good returns would look like. And this is after all of the cleanup and everything that has gone through the system, right? So for example, the very first one to come up is Google. So if we look at where Google is located within our system, it says that Google is within communication services. That's basically where Google falls. That's the sector that is falling into. And then it was compared to Telefónica Brazil, and it was also within, I'm not exactly sure what TIM say that's, but this is fully automated. So we can go through and we can look more into it. Now, Google is part of communication services because a lot of the things that they do is communications, right? That's why it puts it in there. You could also put it in the technology sector, but then you have to weigh it against NVIDIA, which is electronics. You would have to weigh it against Microsoft, which is mostly computer software. And then you would have to weigh it against other technology companies. And it doesn't really allow it to weigh against other companies that are within that sector and have similar returns. That's why I put it in communications. Okay.
Mm-hmm. Interesting.
Now, yeah, if we compare it with other companies within that sector, we can see how they be performing over time, right? So all of these companies have similar returns. The biggest difference that we notice comes with volume. And now here when we see like these spikes, if these spikes are not followed by a drop-off event, like you see here back in what seems to be like September, there was a huge spike in volume. And then afterwards, the volume stayed stable and the stock continued to go on. That's a good sign. That means that it was not a buy off and then sell off event. It's people saw potential in the company and there was good reason for returns, right? Now, if we look at this one, like the VCSH, this is like a straight line, right? So
it's like so
what?
No volatility at all. This is really
Exactly. Yeah, and this is what the software that I built gives us as good returns, like good companies that you should be looking into for investing, right? So afterwards, this is how we go through and we decide what to invest in. Now, if we were looking at other companies, right, like we're going to try to take a look at this one here is right here. Yes.
So it's like
This is
separate companies, right? In technology sector, all of them, or in
right.
communication sector.
All of those were within different sectors. Now, if we look at this other chart, this one is actually all of the companies that underwent what I like to call bubble events. So that means that at some point or another, there was a pump and drop that happened.
Mm-hmm.
So what happens with this is that if you actually invested in one of these, you're going to be facing a drop event because things tend to repeat themselves, right? So if we look at KT, that's what happened. If we look at Q, Triple M, this is what happened.
And what do
You
you
know,
mean by this bubble events? Like, what is it?
so basically, yeah, so what happens is that the algorithm goes through and it recognizes that there was a lot of pressure, panic buys where people went through and they said, oh, the price is going up. I'm going to buy. Now, the system went and it checked fundamentals from the Securities Exchange Commission and it said there's really no good fundamentals to say like this is something that people are buying because it's a good company to buy. So there was speculation. So people bought because of speculation, kind of like what happened with GameStop, right? Everybody bought it when it was like skyrocketing. If you would have bought it within that 1 or 2 week period, you would have made a ton of money unless you bought it at the end, which is when it dropped. You know,
So somebody will have to pay for everything, right?
somebody else will have to pay for it, right? So like, for example, here, and this is really good at identifying those. Like you see here, this is what happened at the top, like right here, and then it started to drop after that. So that's what the algorithm can do for us, is it can tell us which of these events are likely to happen. So you see here, identified a bubble event, and then it stayed flat. Then there's another bubble event here, and then it started to drop, right? So what's good about this is that it allows us to understand that an event already took place, and that event is likely to repeat itself. You see how often these things happen? So what I try to do is, if I see this, I stay away from it.
Basically, this is was the last 3 years, right?
This is for the last 3 years. Correct. This is looking at data over a 3-year period.
And
So
one is 7, one is 6. So this is like in millions or tens of millions of US dollars, correct?
correct. That is correct. So 1.4 million. So here, when we're looking at these different stocks, like if we look at CVNA Caravana, this is one that sells vehicles. So if you notice here, there was like a lot of volume, and then afterwards the volume kind of dropped off. So people stopped believing in this company, but there's people who are buying and selling, but they're not buying or selling that much, right? Not as much as before back in like 2023.
Mm-hmm.
So now the price is super volatile. So this is what these events can do. So like, for example, this CYD right here, the chart indicates that the price is like skyrocketing, but because I see that these events happen here, I'm thinking like, you know what? At some point, this pressure is going to give, and the stock is gonna drop, and we see that continuously in this particular types of systems. Now, another one that we have are weak companies. So these companies here have weak pricing structure because their fundamentals don't support the price growth. So that's why I try not to buy these ones. So if we look at these ones from the very top, for example, Fox News, if you look at the fundamentals, Fox News, or Fox in general, when I'm comparing it to other companies within the same sector, I'm seeing that Fox is not as strong as other companies. So the price is held because of customer loyalty, or because there's other people who believe that the price will continue to go up, which is just like speculation. And I'm thinking, okay, if I have Fox, but I also have other companies that are going to be performing well fundamentally, then I'm going to put my money in other companies, right? It's the same thing with this one. Oh, this is what I mentioned earlier. So Fox A is the preferred stock. Fox is the common share. So Fox A and Fox have very similar patterns when it comes to the price of the stock. Same thing with like IDT and all of this. So all of these ones that you see here, these were deemed to have weaker fundamentals than the other ones that we are evaluating and possibly investing the money in. So why do we talk about all of these things? Well, what happened to me was that 4 years ago, I had like $200,000 in the market, and I didn't know any of this. All I knew is that I had money and I wanted to put it in the market. And at least I was smart enough to have some knowledge about the stock market from the university. So I didn't simply go and put it in one company. I diversified. But if I could go back in time and teach myself a few things. I wouldn't really tell me put your money here or put your money there because that's just not going to work. But I would allow myself to understand concepts like this, that there's fundamentals that should be looked into, that an ETF will diversify, but you can do your own ETF research, and that price strength of a company should be held up by the fundamentals of that company. And if you do your homework, or if you follow this channel, we're going to continue to tell you what are good companies to invest in and what are companies that, if you have a choice between one or the other, perhaps you should go for the other. Of course, the choice is always yours. Now,
We are going to how to build the portfolio.
And how to build a portfolio.
Yeah.
And so we are going to actually look at what my portfolio looks like. So this is the automated portfolio that was created, right? Now I created this 5 days ago. So I bought all of these shares around February 13th. So what happened was that the system told me, and don't worry about this number. This is basically because when I'm putting the shares into the Google Finance portfolio, because it takes me a little bit of time to add them, it shows like a $45,000. That was because I bought $45,000 worth of shares, or I bought nearly $500,000 worth of shares within a very short amount of time. So it shows this number. What you want to focus on is your total gain and your day gain, right? Like which companies are doing well and which ones are not. Okay. So what do we look at here? When I bought this portfolio, I bought it based on the information that I was getting from this table here, which I'm going to show you this. So all of the stocks that you see here, I went through, I analyzed the trends. I looked at the predicted returns. I looked at the implied volatility, which I got from the Black-Scholes equation. And then I looked at the delta, which I also got from the Black-Scholes equation. For anyone not familiar with the Black-Scholes equation, this is how you calculate the fair price of a derivative of a stock. We're going to talk about more about that later. That's a mouthful, but it's like false appreciation. Yeah, it's a big one. But I really like the equation as a tool, right? Don't use it as your Bible because you're not going to do well with it. Like the Black-Scholes equation is a good equation to give you numbers. So it is very good at calculating implied volatility and delta, which gives you the fair option of a stock. So like what is the market price for an option? If you see that the market price for an option is very high, this probably means that the stock is very high, right? Now, if you compare that by percentages and people are paying a lot of money to protect their money, they're expecting an event that will cost them the value of the stock to lose money. If you see that, that's a red flag that you should stay away from, right? That's basically what that means. Okay, so if we are looking at the total gain of the portfolio, if we're looking at John Deere, this one was the one that I was like very happy with because about a week ago when I was looking at it, I was like, okay, John Deere has good news. So I think I'm going to purchase this company. And over a week, it has given me a $6,600 return, which is, just fantastic. Now, if I continue to look, I see that some of these are in the red now. And as you can see here, some of these are zero. So what I have in my portfolio is a 3% trail loss. Why? Because there's a lot of institutions that buy and sell stocks and they want to protect the assets of their clients through due diligence. Once a stock drops by more than 3%, it creates a cascade event where a lot of people are going to see that this is happening and they're also going to sell. When they push to sell these assets, the price is going to continue to drop. So from my personal way of managing my portfolio, I always create a 3% trailing loss on the stocks that I buy so that when an event takes place that causes a stock to drop more than 3% from the peak, I'm going to be able to keep whatever money I have made minus 3%. And then I reallocate that money. So how does that work? All of these ones that you see here have dropped by more than 3% since the purchase of February 13th. So if you see anything here that shows zero, it's because these have sold out, like they have been removed. And then what I do is I take that and I buy other stocks that I believe are going to perform well. So for example, here, when this dropped off, which was on the 17th, it dropped by 3%. Then I had the money available for me, so I bought 100 more shares of this. So what happened is that Road Construction Partners dropped in price. I was able to take $13,000. I bought $7,000 worth of this Vanguard tax managed fund, and then I'm gonna hold it. And my expectation is that between now and a month from now, it will either level off and give me a profit, or it's not gonna drop by more than 3%, right? But as a whole, the market, the portfolio should perform better than it would perform if I simply kept it in the bank. And that's what this does. That's what what you see here. That's why you see these particular steps, because every time that a stock sells, what happens is that I buy something different. And that's when you see this here. Like, that's when you see those steps. Like, the money becomes available, so I'm going to buy something different. And that particular thing that I bought tends to go up in price. And we end up with, $7,000, which if we compare with the S&P 500, you see, there's the difference. Like, we start here. This is when the inception happened on February 13th, as you can see. And as the S&P 500 is moving, so is this. And as the S&P 500 goes down because of heavily weighted companies, the companies that we have selected tend to do a little bit better.
It's pretty nice. It's really nice result to outperform the market.
Well, and that's what we do, right? We want to try to outperform the market when we build these portfolios, because otherwise we might as well just buy the S&P 500 and let it ride. But we don't want to do that. What we want to do is we want to outperform the market on the stocks that we are buying. So that way, the money that we're putting into the stock market is going to give us better results than simply leaving it in the bank, which is going to cause it to erode, or is going to grow in a way that will give us better returns than just buying the S&P 500 altogether, Because if we're looking at this over a year for the S&P 500, I believe that's SPY, if I'm not mistaken. Yeah, this one. Look at this over 1 year. This would have made us, from 610 till now, 683. What is that? That's 610. So that would have made $70. So it's about a 10% growth over a year, or 11.58%.
11.5, yeah.
Right. But we managed to make 10% in a week, or $7,000 in a week just by investing, which means that if that logic holds and we're able to make 1% on a weekly basis, after a month, we'll have increased our profits by 4%. And if it continues to grow, just like you said, it continues to compound, we'll be able to make more money at the end of the year than we would if we simply bought the S&P 500.
It's really cool.
Yeah, thank you. And that is it. So what I will say at the end is that idle capital feels safe because it doesn't move, And so that's where the safety comes from. But over time, stability without structure becomes erosion. A portfolio is not a collection of positions. It is a system designed to preserve and grow real purchasing power under uncertainty. So when liquidity is defined and is allocated intentionally, and execution is disciplined, you end up with a system that's going to give you more money than what you started with. So if you have a goal to spend your money 3 months from now for some big purchase, don't just leave your money in the bank for 3 months. Make it work for you for those 3 months. Then whatever you're buying is going to cost you less because your money has grown in value. And the best part about this is that if you have a currency that is very volatile, you can buy assets that are held in a country where the currency is more stable. And by doing so, you're going to end up not only protecting your cash, but also investing it in assets that are going to grow over time.
It's really good ending for this episode. Yes.
Thank you.
And it's like converting the risk into the profit, and it's like understanding what is the real risk of the asset. It's really, really important. Yeah. So totally agree.
All right. And that's it. So we would like you guys to leave us any comments that you might have, and see you all next week when we continue to follow this portfolio and we see what has dropped off and what has been purchased in order to compensate for the money that is sitting idly in the brokerage account. And with that, we leave.
Absolutely. See you. Bye.
See you next week.